Why BlackRock just invested $2.1 billion into silver before Fed's January decision. A digital world map highlights a $2.1 billion flow from New York into a silver bar graphic. This isn't a trade. It's a signal. The world's largest money manager just made its loudest statement without saying a single word. They positioned a mountain of capital directly in the path of the Federal Reserve's next move. A $2.1 billion bet against the system. Welcome back to Wild East Stories. I'm Marcus. Now, let's begin the analysis. The digital ledgers of global finance recorded it as a simple transaction, a transfer of capital for a commodity. But to the trained observer, BlackRock's acquisition of $2.1 billion in silver in the quiet days before the Federal Reserve's January meeting was not simple at all. It was an anomaly, a strategic anomaly of the highest order. BlackRock is not a speculative hedge fund. It is a fiduciary giant, a guardian of over $9 trillion in assets. It moves with the deliberate, glacial force of an institution that must think in decades, not days. Its decisions are calculated, risk-assessed, and layered with multiple strategic intentions. For such an entity to make a concentrated, directional bet on a single physical commodity, and to time it precisely before a major central bank announcement, is to send a flare into the economic night. The question is not merely, why silver? The pressing question is, why now? The immediate context was the Federal Reserve's impending decision. The market was a chorus of conflicting whispers. Some predicted a continued pause in interest rates. Others sensed a dovish pivot, a potential cut on the horizon. The air was thick with uncertainty. Most investors, the narrator explains, were watching the Fed's lips, waiting for guidance, poised to react. BlackRock did not wait to react. It acted. This preemptive move suggests a fundamental disagreement with the market's passive stance. It indicates that BlackRock's analysts see the Fed's upcoming decision not as a clarifying event, but as a potential catalyst for volatility or a confirmation of a deeper, more troubling trend. They are not betting on what the Fed will say. They are positioning for what they believe will happen regardless of what the Fed says. To understand this, one must view BlackRock's action as a capital signal. In the world of high finance, the movement of large sums of money by a prime actor is a form of communication more eloquent than any press release. It is a statement written in billions. This signal tells us that the world's most sophisticated risk managers perceive a crack in the system. They are moving a portion of the world's wealth out of a purely financial form, a digital claim on a promise, and into a tangible, physical asset that has no counterparty risk. The core thesis of this analysis is therefore clear from the outset. BlackRock's investment is a strategic hedge against mounting systemic financial risk. It is a nonverbal commentary on currency debasement and the fragile credibility of modern monetary policy. It is a calculated position taken in anticipation of a paradigm shift, where the trust in paper assets erodes and the ancient lure of tangible value reasserts itself. But why silver? Why not gold, the traditional safe haven? This choice is the first clue to BlackRock's multifaceted calculus. Gold is primarily a monetary metal, a mirror to the dollar's health. Silver, however, has a dual soul. It has been money for millennia, but it is also an irreplaceable industrial commodity, critical to solar panels, electric vehicles, and advanced electronics. This duality means its value is driven by two engines: fear in the financial system and growth in the industrial world. By choosing silver, BlackRock is building a hedge with two layers of protection. To fully decode this signal, we must journey back. We must understand the metal's 5,000-year role in human enterprise and economics. Only then can we see why, at this precise moment in history, it has become the chosen vessel for a $2.1 billion warning. The key to understanding a modern investment often lies not in the spreadsheet, but in the history book. To decipher BlackRock's $2.1 billion signal, one must first understand the asset itself. Silver is unique. It is not one thing, but two. It is a metal with a split personality, a Janus-faced element gazing simultaneously into the past and the future. For over 5,000 years, one face of silver has been turned toward power and sovereignty. It was the backbone of empires. The Lydians stamped it into the first coins. The Spanish built an empire with pieces of 8 mined from Potosi. The The United States defined its very dollar by a weight of silver. This is the monetary face, cold, immutable, a sovereign metal that speaks the language of real value. It is the ultimate extinguisher of debt because it is not a debt instrument itself. It is simply there. This history is written in the collective human psyche. In times of institutional distrust, the mind reverts to this ancient ledger. But in the 19th century, a new face began to emerge, the industrial face. This was not a replacement, but a transformation. Silver's exceptional conductivity, its sensitivity to light, its antimicrobial properties made it not just a store of wealth, but a tool for progress. It captured moments in photography, carried voices in telephones, and now, it is the critical, irreplaceable element in the modern world. Every solar panel, every electric vehicle, every smartphone, and 5G network relies on it. This face gazes forward, tied not to the fear of collapse, but to the promise of a technological future. This duality creates a fascinating tension. It means silver's price is pulled by two very different masters. When fear rises and faith in financial systems wanes, its monetary face dominates. When global industry booms, its industrial face takes the lead. For most of modern history, these forces have seesawed. BlackRock's bet is a wager that, for the first time in generations, these two forces are about to align and surge simultaneously. They see a world where the monetary face is reactivated by profound systemic doubt. The Federal Reserve, and indeed all major central banks, are trapped. They are burdened by historic debt levels. Their traditional tools are blunted. Whether they cut rates, hold, or hike, each path carries severe, potentially destabilizing consequences. This environment of monetary desperation is the perfect catalyst for a return to the ancient monetary ledger, the realm of silver's first face. At the exact same moment, they see the green energy transition moving from a political aspiration to a physical, industrial inevitability. This is not a speculative trend. It is a mandated global capital expenditure of tens of trillions of dollars. Silver is not an optional component in this new infrastructure. It is a bottleneck. A solar panel cannot be built without it. The demand from this sector alone is projected to consume more than the total annual supply from mines within a decade. This is the relentless pull of the second, industrial face. This is the genius and the warning within BlackRock's position. They are not buying a simple commodity. They are buying a unique asset that sits at the confluence of two historical tsunamis. By placing this bet before the Fed's decision, they are telegraphing a stark analysis. They believe the Fed's action will be a trigger that highlights this very duality. A dovish pivot may ignite inflation fears, boosting silver's monetary appeal. A hawkish hold may crush growth expectations, pushing capital toward hard assets for safety, while the industrial demand engine continues unabated. In their view, it is a strategic heads I win, tails I win position, but only if you believe a storm is coming that forces both of silver's identities to the forefront at once. The historical episode of the Hunt brothers in 1980 is often cited as a crazy speculation. But viewed through this dual lens, it appears differently. It was a dramatic, failed attempt to corner the market on a metal whose monetary face was briefly, violently, reawakened by the high inflation chaos of the 1970s. It was a warning of what happens when the monetary force becomes dominant in an unstable system. BlackRock, with its fiduciary calm, is making a structurally similar observation about monetary instability, but marrying it to an unshakable industrial thesis. They are not trying to corner the market. They are simply positioning in front of what they see as an unavoidable historical convergence. Thus, the metal is chosen. The historical precedent is understood. The stage, set by the tension of the impending Fed meeting, is taut. Now, the analysis must turn to the mind of the architect. What specific, cold calculus in BlackRock's risk models could justify such a definitive move? The answer lies not in charts of silver, but in charts of systemic fragility. The historian can explain the weapon. The strategist must understand the mind of the one who wields it. To perceive BlackRock's $2.1 billion not as a market move, but as a structural adjustment, we must venture into the silent, algorithmic halls of modern institutional risk management. Here, decisions are not born of gut feeling, but from models quantifying existential threats. BlackRock's playbook is not about speculation, it is about immunization. The first page of this playbook is labeled Correlation Breakdown. For decades, the traditional 60-40 portfolio, 60% stocks, 40% bonds, worked because when stocks fell, bonds often rose, providing a cushion. This negative correlation was a foundation of modern finance. That foundation is now cracking. In an environment of persistent inflation and debt-laden fiscal policy, both stocks and bonds can fall in unison, as they did starkly in 2022. This transforms a damping cushion into a correlated trap. Silver, historically, has marched to a different drummer. Its price action is often disconnected from the daily gyrations of the S&P 500 or Treasury bonds. For BlackRock's risk models, allocating to silver is not about chasing yield. It is about surgically inserting a non-correlated asset into the portfolio's core. It is a circuit breaker bought for the day when all the electronic circuits flash red. The second, more profound page is counterparty exhaustion. The modern financial system is a magnificent, intricate web of promises. A bank deposit is a promise. A bond is a promise. A derivative contract is a complex chain of promises. This system functions on trust and liquidity. BlackRock's move into physical silver is a subtle but monumental step outside this web. The silver bar in a secured vault has no liability sheet, requires no one else's solvency to hold its value, and answers to no central bank's printer. In a pre-Fed moment rife with uncertainty about financial stability, perhaps regarding unseen stresses in regional banks or shadow banking channels, this is not an investment. It is the acquisition of a non-counterparty asset. It is the portion of the portfolio that survives, intact, if the web of promises momentarily freezes or frays. This leads to the third calculation, the asymmetric option. An option is a contract that gives the right, but not the obligation, to benefit from a future event. BlackRock's position can be viewed as constructing a physical option on monetary policy failure. The premium paid is the opportunity cost of not having that capital elsewhere. The potential payoff is vast. If the Fed's January decision, or the cumulative effect of its policy, is perceived as a misstep that accelerates a loss of faith in fiat currency or triggers a liquidity crisis, silver's monetary face will dominate, and its price could surge in a nonlinear, explosive manner. The industrial demand provides a solid, rising floor. The monetary fear provides a skyrocketing ceiling. This asymmetric risk-reward profile, limited downside from structural demand, unlimited upside from systemic fear, is exactly what a fiduciary seeking to preserve generational wealth in dangerous times would quietly secure. Finally, there is the regulatory foresight layer. BlackRock operates in the crosshairs of global regulators and policymakers. Their move into a critical mineral for the energy transition is also a politically astute alignment. It allows them to report this not as a doomsday hedge, but as a forward-looking investment in the green economy. It is a narrative shield. In one move, they comply with ESG pressures, secure a strategic industrial commodity, and build a monetary hedge, all under a single, publicly palatable banner. This is capital deployment as high-level diplomacy. Thus, the blueprint reveals itself. This is no mere commodity bet. It is a multivariable equation solved for instability. Physical silver equals non-correlation plus non-counterparty status plus asymmetric optionality plus regulatory alignment. The timing, immediately before the Fed, is the final variable. It suggests their models indicate a high probability that the Fed's coming communication will be a catalyst that makes these esoteric risk management concepts urgent and tangible for the wider market. They are not waiting for the storm to be declared. They are moving to the shelter while the sky is still deceptively clear because their atmospheric sensors, their models of debt, derivatives, and dollar demand, are screaming of a pressure change no ordinary barometer can detect. The Federal Reserve's January meeting was never a true decision. It was a ritual, a carefully choreographed piece of economic theater performed before the world. BlackRock's $2.1 billion bet was not a wager on the script, but a position against the stage itself, a conviction that the theater's foundations were rotting, and the performance, no matter how polished, would hasten its collapse. To understand this, one must move beyond the simplistic hawkish or dovish binary. The Fed is no longer steering the economy. It is navigating a trilemma of impossibilities. It must fight inflation, preserve financial market stability, and service the national debt. It can, at best, choose to fail at one. But the terrifying reality of 2024 is that it is on the verge of failing at all three simultaneously. This is the unraveling consensus. For years, the market and the Fed coexisted in a fragile consensus. Inflation would be transitory, rates would normalize, and a soft landing was achievable. That consensus is now a tattered banner. The data has become a Rorschach test, with bulls and bears seeing wildly different images. The Fed's words are parsed not for guidance, but for hints of which impossible choice they are preparing to abandon. BlackRock's silver purchase is a direct, physical investment in this unraveling. Consider the debt dynamics, the silent, mathematical governor on all Fed action. With the U.S. national debt exceeding $34 trillion, the government's annual interest expense has become a monstrous, all-consuming beast. Each basis point of a sustained high interest rate adds billions to this bill, forcing more Treasury issuance, which pushes rates higher in a vicious, self-feeding loop. The Fed cannot maintain a truly restrictive policy without fueling the very fiscal crisis it seeks to avoid. This is the debt trap. A cut could be seen as surrendering to inflation. A hold could accelerate the fiscal doom spiral. Simultaneously, the financial system is a vessel under immense, hidden pressure. The 2023 regional banking crisis was not an anomaly, it was a symptom. It revealed that vast swathes of the banking system are sitting on unrealized losses in their bond portfolios, a direct result of the Fed's previous rate hikes. The system's stability now depends on the Fed's implicit promise of a backstop, a promise that is itself inflationary. The Fed is thus trapped between validating inflation fears or risking a credit event. This is the absurd theater. Every line of the Fed's statement, every nuance of Chairman Powell's tone, is an attempt to project control over a machine that has already slipped from its grasp. The market's reaction is no longer based on policy, but on perceived desperation. BlackRock's move is a declaration that the Fed put, the long-held belief that the central bank will always step in to prop up asset prices, has expired. It has been replaced by something far more primal, the tangible asset put. When faith in the central bank's omnipotence fades, capital does not simply move to another currency or another bond. It seeks the exit from the financial system altogether. It seeks things that exist outside of balance sheets and political promises. It seeks land, water, energy infrastructure, and yes, monetary metals. By acting before the meeting, BlackRock demonstrated they do not care for the next act in the play. They have concluded the theater is on fire. The silver is not a bet on the Fed's next line. It is a ticket out of the burning building, purchased while most of the audience is still debating the quality of the performance. The Fed's January decision, therefore, is irrelevant as a catalyst. It is merely a confirmation mechanism. A dovish tilt confirms the debt trap is biting, weakening the dollar and boosting hard assets. A hawkish stance confirms the inflation fight is being prioritized at the risk of financial stability, spooking markets into safe havens. A hold confirms paralyzing indecision, which in a crisis of confidence is the most damaging signal of all. BlackRock is positioned for all three outcomes because they are not outcomes at all. They are simply different pathways to the same destination, a crisis of institutional credibility. Their capital has already left the theater. It is now sitting in a vault, in the form of a metal that has outlasted every empire, currency, and central bank in history. The final act is not about what the Fed decides. It is about what happens when the world realizes the most powerful money manager on earth has already decided for them and has moved its pieces to the one corner of the board the central bankers cannot reach.